institutions. So we've built a technology infrastructure stack that allows for traditional financial institutions to be able to tokenize any asset that they're able to custody in a regulated manner and be able to port that over to the DeFi ecosystem. So for us, where we really want to get to, I would say by the end of 2023, is a world in which anyone with a crypto wallet within Cardano can get full access to the US banking system in a straightforward going through a straightforward AML KYC process, at which point in time they can then determine whether or when they want to operate in the unregulated world of crypto or the regulated world of traditional finance.
Welcome to DHN Crypto. On this channel, we focus on global crypto adoption with an added global perspective. If you enjoy unbiased, fact-based crypto content, subscribe and turn on that notification bell. You'll never know which project I'll cover next. Cardano's DJED stablecoin has had an impressive first week. A couple days ago, it even flipped Binance USD in market cap. So it's no surprise to see them really wanting to lean more into stablecoins. Alongside DJED, Cardano is also launching USDA in the coming weeks. However, all this talk of stablecoins has some members in the Cardano community a bit worried that a new Terra Luna situation is about to happen. In this video, we hear from Shahaf Bar Geffen, CodyPay CEO, talk about the inner workings of the DJED stablecoin, and Vineeth Bhuvanagiri, General Manager of Emergo, discuss the coming USDA stablecoin. Together, they illustrate the next era of payments for Cardano.
Well, first of all, DJED is definitely an over-collateralized stablecoin. That's the category to which DJED belongs. Obviously, DJED uses algorithms, and the white paper referred to that, and maybe this is why some view it as an algorithmic stablecoin, but in fact, every software has algorithms, every machine has algorithm in it. So I can get the confusion, but DJED is definitely an over-collateralized stablecoin, and why? So first of all, let's separate DJED from fiat-backed stablecoins like USDA that will hit the markets. Obviously, everything that is fully digital, decentralized is different to fiat, so we're putting that aside. And now let's just compare algorithmic stablecoins, true algorithmic stablecoins, to over-collateralized stablecoins like DJED. So algo versus over-collateralized stablecoins. Both are decentralized, which is very important. We've seen centralized system, especially in crypto, fail many times. So that is important to understand. Now, algorithmic stablecoin stability is based on a governance token, right? Not DJED. DJED is over-collateralized by 4x to 8x. So with algorithmic stablecoins, you need to really trust a governance token that is heavily reliant on the stablecoin itself or the algorithm itself. This is different. ADA is not dependent on DJED. And this kind of like leads us to the next very important difference, which is algorithmic stablecoins. And let's take Luna, for instance, right? Because everybody fears this sort of mechanisms. When it came to Luna, like the collateral is internal to the system, right? So UST was heavily dependent on Luna price to keep the peg, but the other way around as well, right? Because when UST loses its peg, Luna loses its value, creating this circular dependency. DJED is different. To keep the DJED peg, we're actually relying on ADA. Now, ADA is not dependent on DJED. If DJED was gone tomorrow, ADA will very much have value, liquidity, and everything around it. Now, we don't just rely on that, we over-collateralize by 4x to 8x. So the dependency is very different. DJED is capital efficient, right? Algorithmic stablecoins are also capital efficient, but again, they are very much dependent on the value of the governance token. DJED is not dependent on that, but DJED still, while being over-collateralized, is still capital efficient because all the collateral is coming from shareholders, which is a different token. Lastly, algorithmic stablecoins really depend on the value of the governance token to be able to redeem your dollar value if you want to cash out of the stablecoin. DJED is always redeemable for its collateral, which is ADA, and this is how the entire setup is made. So I think this is like the major difference between algorithmic stablecoins and over-collateralized stablecoins. And it's also the difference between DJED and Luna. like the example of what not to be in this market, right? To be clear, DJED is decentralized, and limitations, whether it's geofencing or minimum transactions, all of that is just in the front end. People can interact with the smart contracts as they wish. With that in mind, why we wanted to enforce minimums should be quite obvious. We see this system as a system for minting of DJED and Shen, not for trading of DJED and Shen. So we rather have, a few major transactions than many small transactions that can just create bottlenecks and uptime problems. People were very worried about, hey, you're going to launch this and there's going to be like a long queue. There are going to be a lot of bottlenecks. It will crash. None of it happened actually, and the reason is because we, set this minimas. When people actually want to hold DJED, use DJED and DeFi, they can just take it from DEXs and centralized exchanges. Those who want to mint should do, major transactions. Geofencing and these sort of restrictions are obviously coming from regulatory reasons, and we rather have clarity before we open the front end globally, and this is why we enforce geo restrictions. But other than that, the system is free to use. And it will make sense to think more about the future. So the future for us is, I would say, I see two big things. One is DJED Pay, and DJED Pay will be a payment system a lot like ADA Pay, but now based on a stable coin that merchants and essentially everybody around the world can use. So we're going to use a lot of the stuff that we have for ADA Pay and just repurpose it to do DJED Pay. So DJED won't be used just for the DeFi ecosystem on Cardano, but will actually be used for payments, etc. The other thing, which is I think quite major, in theory, right, and in practice, any native asset can be deposited to the DJED smart contract to build collateral, right? And what we're thinking is, wrapped ETH and wrapped BTC. I mean, why not use this as part of the collateral system for DJED? It will mean that we're taking liquidity from other chains, putting it on Cardano, and generating a stable coin for the ecosystem. So I would say long term, this is what we're looking at.
Product that we've set up to bridge these two worlds together, where we can bring people in from the crypto ecosystem to the traditional finance world in a simple and safe process. The first product that we would like to launch with Anzans is our stablecoin called USDA. So USDA is 100% one-to-one backed stablecoin that we're bringing to the Cardano ecosystem with the help of the other founding members within the space. Anzans is a technology infrastructure platform that we've created to basically sit on top of regulated financial services infrastructure to be able to tokenize the assets that are being held within the regulated custody of these financial institutions. So we've built a technology infrastructure stack that allows for traditional financial institutions to be able to tokenize any asset that they're able to custody in a regulated manner and be able to port that over to the DeFi ecosystem. So for us, where we really want to get to, I would say by the end of 2023, is a world in which anyone with a crypto wallet within Cardano can get full access to the US banking system in a straightforward, by going through a straightforward AML KYC process. At which point in time, they can then determine whether or when they want to operate in the unregulated world of crypto or the regulated world of traditional finance. For me, one of the areas that I'm really excited to be, getting into with this is I want a future in the next upcoming year or so where anyone with a Yoroi wallet, an Eternal wallet, or any of the other wallets within the Cardano ecosystem can quickly move, let's say, a $10,000 worth of ADA from their anonymous wallet into a regulated account at Anzans, be able to take a loan out against that, and then be able to fund a prepaid credit or debit card that they can then use to make real-world purchases using that asset. And with the technology stack that we've created for Anzans, we're not going to just stop with the tokenization of dollars, but our goal is to move far beyond that into tokenizing any currency or any real-world asset. So the goal is to start with dollars, but then at a certain point in time, move to euros, yen, as well as other assets such as gold, commodities, and other elements of that sort. And so for us to be able to offer this, I say I'd like to run you guys through the process right now in regards to how exactly this process works, because I'm guessing you guys are all pretty excited to know or learn more about how we're able to tokenize dollars, how the infrastructure stack works, and everything else. So let me run you quickly through what everything looks like. So through the ANZEN's platform itself, any individual can run through that platform, go through a simple AML and KYC process, at which point in time they actually have a fully segregated account at an underlying financial institution within the United States, a regulated trust company, so to speak. At which point in time they can then fund their account using dollars, credit cards, debit cards, ACH, or wire, as well as a multitude of cryptocurrencies. They can fund their account, and with the press of a button, those funds within that account can then be transferred from US dollars or traditional fiat into USDA. At which point in time that USDA is then issued back to the end wallet of whatever choosing the participant has. So if I have a random wallet that I want to fund with $10,000 worth of USDA, all I've got to do is go through the AML KYC process for ANZENs, tokenize those funds by going through a really simple process, and then at the end of that process, I've got $10,000 worth of USDA sitting within my Yoroi wallet. At which point in time, those $10,000 of tokenized USDA are native assets within the Cardano ecosystem. So those are fully free to exist within the DeFi world or the Wild West crypto world of the Cardano ecosystem. So anyone can move those. We're not going to restrict, or we're not going to look to restrict those movements. Those are free native assets. You can use those on DEXs, DeFi lending and borrowing programs, so on and so forth. And let's say at the end of the day, if you want to move those back into real world dollars and actually make payroll or other things, what you would do then is we would go back into the ANZEN's platform and request a withdrawal. You'll be issued a unique or a client unique burn address where you would then be depositing those funds into. Once those funds reach that unique burn address, we would then actually instruct the transfer of real world dollars from the from our collateral account within the trust institution to your segregated account within that same institution, at which point in time those real world dollars can then be moved anywhere that you guys want within the real world. So for us, this is kind of our first step with this platform for being able to merge these two worlds together, where individuals such as yourselves will have that opportunity and that ability to be able to basically decide when is regulation necessary and when is regulation not necessary, and where would I like to play in the regulated world versus the unregulated world. And this for me is kind of a way in which it allows, I would say, people within the Cardano ecosystem to be able to utilize basically the safety and security of the regulated financial world mixed with that of the freedom and transparency of the crypto ecosystem.